Show. My name is Rob Berger, and looking forward to this live session for an hour and a half. Hope you are too. For those in the chat, appreciate a thumbs up if you can hear and see me, making sure my mic is on. That tends to help. Sometimes maybe not. Maybe I should mute myself. Maybe that would actually improve the quality. I don't know. But would appreciate a thumbs up. I got a couple interesting, well, I think they're interesting things to talk about before we get to your questions. And I'm looking at some of the questions that have already come in, and I will respond to them. Just looking for a thumbs up. There we go. Jay Davis and James T. and Milton. I got 3 thumbs up. I like it. So I was at the Boglehead conference last week and met with a bunch of you. In fact, I've got a photo to show you. If I can work my computer. Here we go. There it is. So we had dinner one night. Here's the crew. And there were some other folks there, I think maybe that didn't make the dinner. I didn't notice in this picture, I've got like a truckload of cash sitting in front of me. I like it. That's how it should be. But no, it was a lot of fun. Enjoyed it immensely. It was a great conference overall. I'd never been to the Boglehead conference before. Man, it was packed. I mean, it's just like it was nonstop for like 2.5 days. But it was great and met a lot of people, beyond this crew. But it was great to meet these folks and talk to them and hear their stories. I met VJAY from Michigan. He actually gave me a ride to the airport, and I learned that the Detroit airport has 6 runways. I didn't know that. And it turns out Chicago O'Hare only has 2. It doesn't seem fair. I think Detroit should give Chicago a couple of its runways. Don't you? I mean, it's got to be a busier airport. And by the way, I do hope that VJ's wife and daughter are not only in the room, but listening to tonight's show. I'm counting on that. Don't let me down. I hope so. But anyway, it was a lot of fun. And actually, what I want to talk about in a minute kind of stems from the Bogleheads conference. But that was a great time. And yeah, so the topic, how did I describe this? How to accomplish the impossible? That sounds like clickbait to me. Who wrote that title? The idea came from, so I was on a panel about retirement. So Christine Benz was the moderator. She's from Morningstar. And Steve Chen was on the panel. He's the founder of New Retirement. John Luskin was on the panel. He's very big in the Boglehead group and is a financial advisor. And then somehow I managed to sneak onto the panel. And, we were talking about different questions that Christine was asking us about retirement. And then towards the end, individuals could come up. They had a microphone. They could ask questions. And this one gentleman, I don't know him. I kind of hope he's listening, but I don't know. He asked the question. He said, as I recall the question, he said, I'm retired. I'm spending significantly more each year than what the 4% rule would allow. I don't recall if he actually said the amount, but we'll say it's, 7 or 8%. And he wanted to know, the market's down. Does it make sense to borrow money from like a home equity line of credit rather than taking money out of a portfolio with the market being down, taking it out of the home equity line of credit, and then when the market goes back up, pay off the home equity line of credit? And I was immediately, that did not seem like a good idea to me. For starters, we don't know how long the market's going to be down. I mean, you could be pulling from this home equity line of credit for quite a long time. And of course, then you're generating interest expense, and home equity line of credit, the interest is variable. So as rates continue to rise, you're going to be paying more and more and more. So I really didn't think that was a good idea. But as I thought about it later, I wish I would have said something else, because that doesn't really solve his problem, right? I mean, it's fine that I sit there in my comfortable chair at a conference and say, yeah, that's a bad idea. But now what I don't know if he'll listen to me, and maybe he'll disagree with me and use a home equity line of credit. But if I could talk to him like one-on-one, if we were having coffee, I think I'd have a couple questions for him. And the first would be, is your current spend rate temporary? I mean, maybe he has just some one-off expenses this year. And that's why it's a 7 or 8% withdrawal rate, but next year it'll go down. Or maybe it's that high because he hasn't started taking Social Security yet. He's going to start taking Social Security, whatever, say in 2 years, and then it comes back down to a more normal level. I don't know the answers to those questions, but those would be the kinds of things I'd be asking him. But let's imagine his answer is no, this is it. I'm kind of needing to spend 7 or 8% a year. It's not temporary. How do we try to help someone like that? Or how would we think through that issue, maybe if you're confronting it? And here's the thing we know that that's not sustainable. It's very, very unlikely that that kind of spend rate in retirement is going to be sustainable for more than, let's just say at the outside, 20 years. And depending on, how the market behaves and inflation, he could be out of money in 10 years. And so if he keeps spending at that rate, he's very likely to have to make some very, very difficult decisions. And so what I would do is I would challenge him to say, look, let's play, I call it the what if game. What if you couldn't take money out of your home? You couldn't do a home equity line of credit. This wasn't allowed. Let's just pretend. And what if you could only take 5% out of your portfolio? You can't take 7 or 8%. What are you going to do? Now, when you're confronted with that kind of question, at least when I'm confronted with that kind of question, my initial reaction is, well, it's over. It's done. I'm dead. I don't know. It's impossible. I can't do it. We immediately, I think, throw up mental roadblocks. I did that when I made the decision in 2005 that my wife and I would be totally debt-free by 2012, 7 years. It was impossible. Mathematically, short of winning the lottery, and I don't play the lottery, so that's kind of a stumbling block to winning the lottery. It's mathematically impossible. But what I've found is that when we actually embrace that kind of impossible goal, don't just immediately reject it, it forces us to start thinking about options that we would have normally not thought about. It's sort of like, what is it? Necessity is the mother of all invention. If you had to live on 5%, but you're living on 7 or 8, what are you going to do? And you start thinking about things like selling a house and downsizing, moving to an apartment, moving locations, depending on your living circumstances, living with someone else, getting a roommate. Again, many of these things might not end up working out, or they may be just what you don't want to do. Getting rid of a car, getting rid of 2 cars, starting up, maybe getting some part-time work. It forces you to think about options that you have been putting off or that you've been ignoring. One way I like to look at it is, what if someone told you that if you can live on 5% without borrowing for the next 5 years, they'll give you $10 million? Now, could you do it? Is it possible? What would you have to do? What would that look like? And I think that kind of thinking can open up possibilities that we wouldn't have otherwise thought about. I can tell you, if you go down the path of using debt is sort of the easy way out. I'm not saying it's not appropriate from time to time. We borrowed to buy a home. In the past, we've borrowed to buy a car, but it is the easier path. And if you say, well, I'm not going to go into debt, now what do I do? I see this with businesses a lot, small businesses, where I'll talk to small business owners that have gotten into trouble with debt. And it seemed to make sense because they're trying to build a business and make money, and it's an investment. And, sometimes it is appropriate, of course, but how would you start your business without debt? Well, that's impossible. Well, okay, but what if you couldn't borrow? What if the rule was, if you start a business, you can't borrow for 3 years? What are you going to do? Is the answer you're just not going to go into business? Or are there options? Think them through. And, when you do that, I wrote about this in my book, Retire Before Mom and Dad. When you really force yourself to ask these sort of impossible questions, a lot of times you'll conclude, yeah, that's impossible, or it's just so bad, I don't want to do that. I'm 56. I don't want to move back in with my mom. Okay, I get it. Mom, I hope you're watching, by the way. Love you if you are. Hey, I love you even if you aren't. Yeah, a lot of times you go down this path and you think about it for a while, and yeah, it's just not going to work. But a lot of times you end up saying, well, yeah, no, maybe I could do this. We went we had 1 car. We had 2. We got rid of 1. And we weren't sure what it was going to be like. And it was fine. Now, we've since gotten a second car, largely because of our granddaughter. And that, in all things considered, that may not be the hardest, cross to bear, getting rid of a car. But I think thinking through difficult issues this way, it could be about money, it could be about other things. Not being so quick to try to avoid the obstacles. What Ryan Holiday's book, "The Obstacle is the Way." There's a lot of truth to that, and having the obstacles in front of you force you to think creatively, force you to think outside the box. And I wish I could have somehow conveyed that to the gentleman, but I didn't. I guess just wasn't quick enough on my feet, although I was sitting down. Anyway, there you go. That's my 2 cents. So I do have a couple questions real quick. One is, so I'm starting to do reviews of like financial planning software. I've done one for Personal Capital's retirement planner, which I'm going to publish Wednesday. I think next week I'm going to review this one, which many of you have emailed me about, Projection Lab. And I've got a bunch that I'm going to work through, but I'm curious in the chat, are there tools, apps, planners, whatever that you would like me to review down the road? If there are, can you just put them in the chat right now? I've scrolled all the way to the bottom and I'm just waiting. So anything you'd like me to review, I'd like to hear about it. And then I have another question. I don't know so I mentioned the tool Fortunately, which, let me just show it to you. I mentioned it in the newsletter. And I know the founders. I'll actually log into it. I think I just have demo data in here. I think, yeah. So here's what the tool looks like. It's really not for people in retirement. At the moment, it can't model Social Security. It doesn't model Roth conversions. It doesn't model Medicare payments. But it could be something useful to someone. And by the way, you see I was just playing around with data. This particular plan has a 0% chance of success. And there are some things that I'm not sure about. Like they have no qualms about putting a fair amount of bonds into brokerage accounts, because you can see down here, they recommend a portfolio. They do recommend a portfolio of low-cost index funds, so I'm thrilled with that. But you can model things like buying a home, saving for college education, and it will give you ideas as to how to prioritize those goals. So I think there's a lot of potential for this app. But the one question the founder Seth asked me, and I'm going to put in a little poll. Let me see how I can word it. Would a budget app, that's what I'm going to call it. This really isn't a budget app, but that's what I'm going to call it. Would a budget app that automatically allocates money to I'll call it a fund account, be useful to you? But by fund account, the idea is, if it did this automatically based on spending patterns and expenses, and then it said, okay, based on all this, we're going to crunch the numbers. Here's money you can spend without guilt, without fear. It's going to be just a fun money account or fun account, whatever. And that's the question. Would that be useful to you? That's it. Would it be useful or not? That's the first question. While you're answering that, let me go back. Okay, new retirement. So Jeff wants to know, I did a whole live show on new retirement, but I'm going to do more on new retirement. So that's good. Noreen says, tools for folks 50 plus who are way behind on saving for retirement. Well, all the tools can help you with that. But I'll focus on that when I'm doing some of the reviews. We may not like their answers. Okay, Fidelity. So I'm going to take a note here. Fidelity. So Fidelity's retirement planner. Tools to review Fidelity's retirement planner. That is a full view, right? Well, they might have a separate. No, I think it's just full view, which is based on eMoney Advisor. Right Capital. Okay, Right Capital is a tool designed for advisors. I can get access to it, and I am doing another tool called. Let me make sure I get the name right. I think it's Income Lab. No, hang on. I am going to review another tool that is for advisors as well. Right here, it's called Income Lab, but it's incomelaboratory.com. It's a really cool tool visually. The reason I've held off reviewing it yet is because it's for advisors, and so like their minimum cost is like $100 a month. So I doubt that's I don't know how helpful that's going to be to folks, but you might find it interesting to look at sort of an advisor tool, what they might be like. So I'll probably do that. All right, so I see a few more. All right, so we'll get to your questions. How's the poll coming along? So far it's 34% yes, 35 yes, 65 no. All right, good. Keep answering that if you haven't. I'll get to your questions. So let's see here. I actually cut and pasted some that came in early. So Marcus wants me to revisit the article about annuities and retirement. It was in last week's newsletter. I believe it was from Morningstar. Yeah, it was. I couldn't find the study last week, which is what I was looking for, but it doesn't really matter. I mean, I found it since then. I've read it. But here's the article. And in fact, let me do this. You can see all of the archive, not all of the archives, but the archives since I've been using my current newsletter provider. So it's about 15 of the last newsletters and I'm dropping into the chat a URL. If you go to that URL, it'll show up the last like 15 newsletters. So this was one of them. And you can see, when you click on the link for the study, if you want it, you've got to give Morningstar your email, but you get the study. Here's basically, but I can tell you basically what it said. So it said, you can imagine three buckets of people. Those that haven't saved enough for retirement, whatever that means. Annuities aren't going to help them anyway. Those that have saved more than enough probably don't need an annuity. Now, what they said in the study was, after factoring, guaranteed income like Social Security, whatever you now need to cover your expenses from your portfolio, if your portfolio is at least 36 times that expense, so we're talking a withdrawal rate of like 2.7%, you don't need an annuity. And then if you fall in between, an annuity might help, although what they found was your first line of defense would be what they called a Social Security bridge, which just means deferring Social Security until you're 70. And that covered most people. Beyond that, some folks might benefit from an annuity. They looked at several different types, but primarily it would be an immediate annuity or a deferred annuity, low cost basic annuities. And by the way, Mike Piper was at the Bogleheads conference. He's the blogger. He's a CPA. He has a blog, Oblivious Investor. I've mentioned him before, and I've known Mike for many years. He's agreed to come on the show. In fact, I need to email him and set that up. One of the things he's done is this free tool called Open Social Security. I'll show it to you. Here it is. And it helps you figure out when to take Social Security. So he's going to come on the show. We'll talk about this tool and other things to consider when, thinking about when you're going to take Social Security. So I don't have a date yet, but that's that is going to happen. And in terms of annuities, one way I like to think about them is, and I can't show it to you, but whatever tool you're going to use, new retirement, personal capital, any of the ones we're going to look at, have your base plan, right? In my mind, unless you already own an annuity, it would be like, it wouldn't include an annuity. If you have one already, you obviously would include it, but assuming you don't, have your base plan and then run comparison scenarios. And you can do that. Like, for example, I'll just show you in personal capital. Personal capital, I did the video today. I'm not publishing until Wednesday. This is a demo account, but I was actually, I've used this tool for a long time, but I really dug into the details for the video. And this is a much more sophisticated tool in terms of the retirement planning than I realized. But one of the things you can do, and you'll notice this plan has an 11% chance of success, but that's because I was just goofing around with some crazy numbers. You can model an annuity, right? Before taxes or after taxes. It probably won't be increased by inflation. I don't think they sell any more inflation indexed annuities, but you could switch this assumption if for some reason some way you found one, and you could model that. And you would need to adjust your savings amount to reflect whatever the amount you were going to use to purchase the annuity. But what you could do is create a new scenario. And I walk through in the video how to, not with respect to annuities, but just generally how to do this. But you basically create a new scenario. You call it whatever. Oh, they don't like all that. Okay, you call it whatever. And then you can make changes to this and then compare it to your original. You can actually do this and then compare it to your original plan. And it's pretty nifty. It's certainly not as sophisticated or robust as some of the other tools I'll look at, but it by far the best free tool, at least that I know of, one of the best. So, but that's conceptually, I think that's how I do it. I have a base plan, and then I would do some scenarios where, I add an annuity or an annuity of varying amounts, or change when I claim Social Security, and work with those things to see how different options would affect my plan. Okay. A couple other questions that came up before I went live. So Kokalti, who's on the show every week, I think, and I'm sure I'm butchering that name. Regarding your clip on beating the actively managed funds, which was a short clip I published today, do you mean the ones that trade in and out of stocks, or the ones that pick stocks and hold them? Well, what I mean is non-index funds, right? That hire people to try to pick the stocks they think will do best. Some of them trade more than others, but that's what I mean by actively managed. And the data for that, by the way, comes, as I mentioned, is it SPIVA? S&P, Standard & Poor's index versus actively managed is what SPIVA stands for. And this is if you just Google it, you'll get to this page. And you can look at different countries, but we'll stick with US, and you can pick a time period. And so like over a 10-year period, you can see 90% of funds underperform the S&P 500 for large cap. And 15 years, it's about the same. 1 year, you're going to have more that beat it, but still not a lot. Well, 55, that's not bad. But you get out to 3 years, and the numbers start to get ugly quick for active management. And then you can come down here, and you can look at different asset classes. One of the best was actually large value, but still 75% of them over 15 years failed to beat the averages. Yeah, so it's active management is just proven to underperform. It's not pretty. All right, what else we got today? Natalia wants to know, would you add sector-specific ETFs into a taxable account? Well, I don't use sector-specific ETFs. Whether I would or not would depend on the sector, I think. I'm guessing that some sectors have higher distributions and therefore more taxable income. So if I look at what's the Vanguard Financial ETF, what's the ticker? VFH. So if we go to Morningstar, I'm guessing this is one that has a decent amount of distributions because it's effectively a bank fund. Although I do own banks in my taxable account. Well, that's not too bad. It's 2.42, 249 SEC. That's not horrible. So that might not. Oh, let's look at. Although we should always look at capital gains, so we can go to distributions. They probably don't have any. No, that's not horrible. But to answer your question, I would look at this. I would look at the distributions. I would make sure they're not distributing any capital gains. I don't want that, and that their yields are somewhere consistent with the market as a whole. Before I would consider putting them in a taxable account. That's how I would approach it. All right. So Rayhan wants to know if I would consider replacing, say, 15% of of my portfolio of the, let's say we got a 70-30. Is that right? Yeah. So I guess he's got 30% in bonds. Would I be willing to take half of that and put it in Fundrise, which is a real estate syndication service, I guess you could call it. I interviewed the CEO, Ben Miller. I think that's his name. Yeah, I think. Anyway, a few weeks ago, I would not. I think that, private REITs can look like they're not very volatile, but I think it's a question of valuing the underlying assets. It's a REIT. I wouldn't replace bonds with a REIT, whether it's a publicly traded REIT, private REIT. I wouldn't. Yeah. Okay. And then Michael mentioned that there's still a glitch with gifting IBonds, Treasury Direct. However, I've gotten several emails and I've seen several comments that there's no longer a glitch. It actually works. So I have not tried it, but that's what I'm told. And I just noticed that someone I've not seen in the show before, Ratty, had the nerve to say that there's too much clutter on the shelf. I don't know what you're talking about. It's calling my stuff clutter. I like it. Makes me happy. Okay. Now I'm done with all the pre-show questions. Now I'm going to, I don't know, whatever's next. Yeah, like, here's Bob. He says he was able, right here, was able to buy a gift IBond yesterday morning. So Kevin asks, I postponed my retirement because of the market drawdown, but want to retire at the end of the year. Is it safe to withdraw 5% for the first couple of years before Social Security kicks in? Well, I think I actually did a video on this. Didn't I? Sometimes I just think about doing a video, and then I think I've done it. It happens. Let's see. What I often forget, though, is whether it was part of a live show or not. That's actually what I can sometimes not remember. Thought I did. In any event, it doesn't matter. Yeah, I think that's probably works. I would run it through some tools because the idea is, you take Social Security a few years later, and so you're going to reduce, your withdrawals. Now, I suppose, what do I know? Maybe you're worth 400 million and you want to spend 5% of that every year. And when Social Security kicks in, you're going to get $40,000 extra dollars a year. And so it really doesn't make much difference. But assuming you're not worth 400 million, I think that's conceptually a very reasonable approach. You can use any of the tools. Even personal capital can do that. I'm pretty sure. Have I tried this before on the show with personal capital? So I think what you would do, let me just see if I can. Yeah, I think you can. So what you would do, so when you get into there, again, you don't have to use personal capital, but just conceptually, this will show you. And let me pull a comment off the screen. So I think this retirement spending here is, when you come here, it automatically, this is sort of a given. Of course, you can change the number, but this is a given. So here's what I would do. I would put in here, let's say 4%, right, is 40 grand. All right, I think we can do this. Oh, that's a month, isn't it? Let's try that again. All right, so we got 40 grand a year in. And we'll just remove some of this clutter. All right. So the idea is, so here, this is perfect. So 65, right? But Social Security is not going to kick in until 67. I don't know how well you can see that there, but that's the deal. But so far we haven't dealt with that extra 10 grand because you said 5%. I'm assuming I've got roughly $1 million portfolio. So I think we can just come here to, I think we can, it's for life. Oh, wait. Yeah. So, yeah. So what we do, other expense, 10,000 per year. And then you'd have to set this yearly for a set number of years. It'll start at 65 for 2 years, right? save it, and you could run the analysis that way. Again, your numbers, of course, I'm sure are going to be very different. But yeah, so you could, and you could do the same thing in new retirement. When I look at Projection Lab, I'll look at that because a lot of people ask me that question about a slightly higher withdrawal when you start retirement that comes down when Social Security kicks in. So it's a good question. But I would model it. I would look at that, with a tool. The tools are not, they're not gospel, but I think they're helpful. I can't do that kind of stuff in my head. I don't know the math off that. But conceptually, yeah, I think that should work. By the way, if you want to ask me a question or have me cover a topic, put @ in my name if you would. Helps me find them faster. So Jeffrey, I don't know. I think he's going to ask me. He's asking me this, but maybe he was asking the chat. But would a good asset allocation be 33% VTI, which is Vanguard's total U.S. stock market, 33% SCHD, which is Schwab's dividend fund? It's basically a value fund. It's tilted towards value stocks. Value stocks being older companies that have been around for a while. They may not be growing as fast as the high flyers, but they pay consistent dividend and they have good value. And then 33% other dividend stocks. Well, so the first thing is you're 100% stocks. So I personally am not a fan of that. I suppose if you're in your 20s and you're saving for retirement at 65, I can't argue with that. Maybe even if you're in your 30s. But that would be the first question. Do you really want 100% stocks? Second question would be, do you really want to pick individual stocks? I know I have some, and it's now about 20% of our portfolio. Not so much by design. I started out with a much smaller percentage, but some of them have done well. But I don't think it's for everybody. Maybe it's for you. I can't answer that, but it does add some company-specific risk to a portfolio. The next question I have is, you're basically all in on U.S. large companies, right? VTI is effectively a large. I mean, it's got some small cap, but it's predominantly, we can look at it. I can show you what I mean. Just pull it up in Morningstar. Go over to portfolio. And if we look at weights, we can see it's got some small and mid cap, but the majority of it is large cap stocks. SCHD, same thing. Pull it up here, look at the portfolio. I own this. I own both of these. So, I mean, I think they're good funds. That's not an issue for me. You can see its value, but still large cap. And this is probably even more large cap, than VTI, or about, well, I guess about the same, but certainly fewer small cap. And then you've mentioned some, pretty large companies, Verizon, AT&T. So, you're heavily weighted to large cap US. And I'd be uncomfortable with that kind of concentration. I'm not saying it's wrong for you, but those would be sort of questions. If we were having coffee, those would be the questions I'd ask you. Are you sure that's what you want? Noreen, yes, those were all folks that from the YouTube channel at the dinner. I know, isn't that amazing? We can we'll take over that place. That Bogleheads was laughing. By the way, next year it's here, DC, so that'll be fun. So first, I don't know about this ratty person. First, making fun of my clutter, then says, I think in reference to the Boglehead conference, that there's a lot of old folks there. It's kind of true. Made me feel good. I felt young again. All right. Paul, you had a great website you shared a couple of weeks ago that modeled a portfolio for any given year in the last 100 years, assuming you retired then. I think you mean this one. Right here, FiCalc.app, I'm thinking. Let me pull off your comment. Because, you get all of these years down here. Yeah, this must have been what you meant. Since we're on FiCalc, I was thinking about doing a video on this, but I'll just share this idea with you that I had. So this is $1 million portfolio, 30-year length retirement, $40,000 first year withdrawal, adjusted for inflation, 4% rule. It's got a lot of cash. Let's just do, we'll do a 60. It doesn't really matter for what I want to show you, but we're going to do a 60-40 portfolio. All right. You'll notice, so the years in red are years where you run out of money. So if you retired in 64, you ran out of money. I don't know how well you can see that, but in 29 years, right? So you were close. And if you look at, let's look at, so I guess, is that orange, yellow, brown, whatever, means you didn't run out of money, but you came close. So if we look at 73, and this line is on an inflation adjusted basis, but you can see it lasted for 30 years, but you were pretty close to running out of money. That's 73. Now, if we look at 74, it's just a year later, right? Now remember, let's go back to 73. We're going down, right? Now go to 74. Well, we started to go down, but then we went up. And so, we're looking pretty good after 30 years. On an inflation adjusted basis, we have more money than we started with. That ain't bad. And then if we go one more year, it gets even better. We don't even really go down that much. And look what we end up with here. Almost $8 million inflation adjusted after 30 years. Boy, won't our children be happy. Now, why is that? Why 73, 74, 75? Just, why? Now, if you're a stock market historian, you know that 73 and 74 were both bad years for the stock market. And in fact, you can see it, it dropped January 74, and then it dropped again 75. Now, so this first drop is the 73 year, second drop is 74 year, and then it bounces up in 75. If you retire in 74, you only get one of those drops, boom, and then it goes up because you didn't retire at 73, right? And then if we pick 75, you skip both of those drops and you actually go up the first year. So that's certainly part of the story. But if you think about it, let's assume you were thinking about retiring January 1, 73, and you say, I'm going to wait a year, or you're going to wait 2 years. Well, in both those cases, yeah, it's true. You're not pulling your money out as the market's going down. That's good. And you're still working. So maybe you're putting a little bit of money away. That's good. But your portfolio is still dropping like it is this year, right? I mean, you weren't sheltered from the terrible market that was 73 and 74, right? Here's the thing. Once you get, let's say if you wait a year, even with contributions you might make, that year, your overall balance is likely to be down if you retire a year later, January 1974. And it's going to be down even more if you wait until January 1975, because 74 was a really bad year. The point is this: you're starting out, your 4% is a lot lower than it would have been had you retired at January 1, 73, right? Because you lived through 2 years of a pretty bad market, unless your contributions were just through the roof. But short of that, you're taking out a lot less money. Your base, that 4%, which is what is going to then, from that is what you're going to build up with your inflation adjustments, is a lot lower. And that is a big part, not the only part. Obviously, timing matters in terms of the market and inflation. But as you know, inflation was bad all the way until 82. But your withdrawal is a lot lower to start with, or lower. Depends exactly when you retired, but it could be a lot lower than someone, say, retiring January 1973. And we could look at this year. I forget his name, but someone said they were waiting to retire maybe till the end of the year. So unless they've made huge contributions, their balance is a lot lower today than it was in January. And so if they're going to follow the 4% rule, they're going to end up taking out less money. Now, that works fine if that works for their plan. But that's one of the reasons a year, and certainly 2 years difference as to when you retire, can make a huge difference to outcomes, which actually gives us some, if you did retire January 1, one approach to dealing with this is to cutting back your withdrawals right away, if you can, right? Now, not everyone wants to do that, and not everyone can. And there's another argument that you spend more early in retirement than later. So maybe you don't cut them back, but maybe you skip an inflation adjustment. Anyway, I don't know. I thought I'd share that with you. No one asked. Well, apparently there's a airport, Cord, no idea where that is. ORD. I don't know. It's Cord. Has 7 runways. We got to get to the bottom of this. It's O'Hare. What's the K? I'm confused now. I don't know. Hope VJ didn't lead me astray. So Kevin wants to know what are the Padres' chances versus the Phillies. I thought the Phillies were out. So that tells you what I know. I have no idea. I haven't been watching. Should I be embarrassed about that? Look, if it's not the Cincinnati Reds, does it really matter? Although I should say, so this is how bad I am. I saw the Guardians, and I'm like, the Guardians? What a stupid name. What are the Guardians? Do we add another baseball team? Then I realized it's the Cleveland. I don't know. I've been living under a rock. So I will root for the Cleveland Guardians. Oh, it looks like it's tied 2-2. Yeah, the Phillies. Someone told me the Phillies lost. I mean, I know they beat the Cardinals. I thought they were out of it. Anyway, yeah, I have no idea, by the way. All of that is to say, I don't know. All right, I've got a question for you. I'm going to add another. Do we shut down that other poll? Okay, so 66% don't want a fund money feature. Okay, I got another question for you. How do I? That's not what I want to do. Hang on. Here we go. Do you bet on sports? There's so many ads now. MGM, I don't even know them all. DraftKings. I will say that the Peyton and Eli and I guess Archie and the Mannings, their commercials are hysterical. But I'm curious. Oh man, we've already got. I mean, a quick 96% said no. I'll vote as well. Can I vote on my own poll? I can't. That's not fair. I can't vote. That's wrong. I'm going to email YouTube. Well, I'll tell you in a minute. I don't know what this question means. Any chance Bogle will be published someplace? I don't know. Can you rephrase that question? There's VJ. Hello, VJ. I hope your wife and daughter are watching and listening. They don't have to watch. Yeah, they don't have to watch. All right. I told VJ that he is so nice. I can only assume that in a previous life, he was from Ohio. It's the only explanation I have. Okay. Oh, good. So this is fun because this is a fund I've never heard of. So Lopez says TRBCX fund will be converted to WLGABX. I didn't know there were funds with 6 letters in the ticker. In my 401k, what are your thoughts on that fund? Is FXAIX a better option? Well, we know FXAIX, right? Let's see here. WLGAB. It might be a kind of fund that doesn't show up in Morningstar because some of these retirement accounts, yeah, have weird tickers. It's not showing up. Let me Google it. Here we go. It's a Class R1 fund. It doesn't really mean anything, really. Large cap growth. Well, here, I'll show you what I'm looking at here in a minute. But if you look at, so we've looked at FXAIX before. Here it is. It's just an S&P 500 index fund, right, from Fidelity, right? So that's plain vanilla, really cheap, cheaper than Vanguard's, by the way. The other fund that you mentioned, I pulled up here. It's a large cap growth. So first of all, I view these are two notably different funds. For sort of a core portfolio, personally, I would much prefer an S&P 500, possibly a total stock market. But if you watch my video on these two funds, total stock market versus S&P 500, they're basically the same in terms of performance and risk. I really have never invested in a growth fund, so it's really not my kind of investment. I'm not to say that it's bad at all necessarily, but it's certainly less diversified, I guess I would say. And this has no data on costs. So, and this is not helpful. So let me see if I can find some more data on this thing. I'm surprised it's not in Morningstar. Man, this must be a quirky fund that's available in retirement accounts, is my guess. Yeah, I'm not seeing any data on it. So, but other than it's a large growth. So that's how I would think about it, the asset class that it's covering, and whether you want large growth in your portfolio. I would look at the expense ratio. I can't get data on that, at least not that I can find in a couple of minutes. That would be very important. So Banana wants to know, which is wiser, increasing dollar cost averaging in a 3-fund portfolio while everything is on discount, or putting the excess into IBonds? So the first thing I want to just nitpick on, I understand the point. Things are on discount as compared to, say, whatever, 6 months ago. They're cheaper. I get a little squeamish when though, because to me, discount is not based on what the price was sometime in the past, but rather as compared to the fair value of the investment. And one could argue they're still overvalued. Now, that wouldn't change my investing approach, at least in this scenario where you're just dollar cost averaging into your low cost index fund portfolio. I just keep buying every paycheck or whatever. But whether you should put excess funds, I mean, the IBonds I think are a good deal now. Long term, they may not be. I mean, the fixed rate is 0. I don't know if it'll go up in November. We'll find out. I mean, TIPS have a real yield right now. I mean, the 30-year I think is around 1.7. It's just that the inflation rate has gotten everyone's attention because it is a lot of money right now. But long term, you're basically guaranteed to mimic inflation. A 3-fund should outperform inflation over the long term. But it really just depends on your overall, portfolio. I probably personally wouldn't. For me, I'm not going to divert money that I would otherwise plan to put in my overall asset allocation plan to IBonds. I might make IBonds a part of the bond portion of my portfolio. I don't think that's unreasonable to have some amount of IBonds as part of your bond portfolio. TIPS are probably easier to deal with, but they're in some ways a more complicated beast, I think. There's a lot of argument that says they're not really great at inflation protection except at the shorter durations. I haven't really wrapped my mind around all of that yet. But anyway, that's my reaction. All right. Sir Finley, welcome to the show. UK, interesting times. What's going on with the politics there? Is she still in? Is she out? I don't even know what's happening. Anyway. Okay, Amy, great question. You've got rental properties. You plan to keep them. How do you account for rental income during retirement using your financial freedom spreadsheet? Boy, it's funny. I haven't looked at that spreadsheet in forever. Let me see if I can pull up a version of it. This is funny. So I found a dough roller, whatever, 15 years ago. I haven't owned it for a number of years, and I don't do any work on it anymore. But this image right here, I have a vivid memory. I spent, you wouldn't, how much time I spent creating that image. I am so proud of that image. Okay. Let's see if I can pull it up. Here it is. I think I created a separate version of this at one point. Well, I mean, for this spreadsheet, I don't know if this is the one you're talking about, right? But it has your annual income and then a withdrawal rate. So, and then the idea is it knows how much you spend, for expenses based on your savings rate. So if you're saving 5%, you have to be spending 95, right? Because just math. So I would include in this number your rental income along with salary. So I think that's how I would do it. Now, this may not have been the spreadsheet you were referencing. So if it's not, let me know. But that's how I would do it. I would include the rental income in this spreadsheet, right? I think, yeah. Now, if you, and if you, let's imagine you don't spend any of it. You just invest it all back into the, into real estate, more real estate or whatever, then that would just, that would just get factored into your savings rate. That money that you don't spend would be saved. So, I don't know where you'd be on this, on this chart here or the spreadsheet, but yeah, I think that's how I would do it. And if that's not the spreadsheet, let me know. 8 runways. We're up to 8 runways. I emailed you the airfield diagram. Randy, thank you. Now, is this, now this better not be O'Hare, or VJAY has some explaining to do. I see an email from Noreen, flexible retirement planner. I think I've actually seen that one before. Yes, I'm AD Dean. That's not what I wanted. Yes, I'll add this one. This is one I'll review. I think this one might be free. I'm not positive, but I've seen that one before. Okay, back to the airfields. This is very important. Just so you guys, I know you guys want to know, this is the airfield, Detroit. Okay. Wow. 8 runways. Okay, well, they probably did that just to have more runways than we have in Ohio. That's probably what they did. They're like, we don't even need 4 of them, but let's, we got to beat Cleveland. Okay. People new to the show are probably like, what is wrong with this guy? Actually, people that have been watching the show for a long time are probably asking the same thing. Did he bump his head? He does look older than I remember from last week. Maybe the trip to Chicago, maybe the Bogleheads, maybe all those old people at the Bogleheads conference rough Rob up a bit. He's a little shaky. All right. This is a good question from Ricardo. Do you recommend investing 20 to 25% of your income? Well, first of all, I think that's glorious. Or 15% and use that the difference to pay low interest loans. Well, someone's in their 30s. Part of it would depend on what's low interest. What are we talking about? What kind of, it would also, so that'd be one question. What's the actual interest rate? Another question would be, what's the loan for? Is it a mortgage? Is it student loans? Is it a car loan? The other thing I would ask is, should you be saving money now for big purchases down the road so that you don't have to go into more debt? So, for example, do you have your next car planned for so you can pay cash? So I'd be more interested in that than paying off a low interest loan. And then, part of it would be how much debt do you have relative to your income? How stable is your income? So I'd be kind of thinking about those sorts of questions. Just from the numbers you've given me, it sounds like it may be the case that either option might be reasonable. I mean, if you can save 20 to 25% of your income, that's a pretty healthy savings rate. Another question is, again, it kind of related to something I said a minute ago, but are you avoiding new debt? Because given your savings rate, I would think you would be. But then again, maybe you're saving to buy a home. So those would be the kind of the things I'd be thinking about. New retirement is on my list, VJ. As I said, I've done a couple of videos about it, but I will do more. What happens is, so like I did the personal capital, I did the video, I created the video today, I haven't published it, and here's what it looks like, by the way, behind the scenes. Okay. It's, how long is this video? It's 23 minutes, which, a lot of my videos, I've tried to get on a little shorter, on a bit of the shorter side. You get into like new retirement, there's so much to the tool. I could easily do an hour-long video. So I don't know if I'll break it up. I don't know. I'll figure that out. Vinyl, I'm glad you didn't forget to show up. All right. Yes. So Kathy, Pralana, I'll show that for folks that want to see it. It is on my my list. It comes with, here it is, or the website, if it'll come up. It's not much of a website. I think it's a guy behind it. It's basically a spreadsheet, and I've bought it. It comes with like a nearly 200-page manual, and the spreadsheet looks really complicated, so I'm going to have to figure that out. But I will, yes, it's on my list. So JPZ wants to know what I think of Fidelity for someone just, retiring. And I will look at some of their tools and do reviews of them. If I had to pick a single broker, it would be Fidelity. I think they're the best. In terms of tools, ease of use, the website, the apps, security, customer service. So I think, for retiree, I think when you're just accumulating, which broker probably doesn't matter as much. If you say you've got an IRA, but once you start to retire, you've got to deal with, cash management, pulling cash out of your portfolio, RMDs. You can open up a checking account with them if you want it and keep everything there with a debit card and a credit card. I don't do that to that level, but you could. Actually, that's not true. I do have their debit card. I've just never used it. So this is interesting from Dabriga, I don't know, that you use Right Capital. So again, I haven't started using it, but I can. Here it is. But now I wonder if you have it through an advisor. Be a question for you if you let us know. But as you can see, this is per month, $140. So I think most people aren't going to shell out that kind of money. By the way, let's take a look at the poll. Do you bet on sports? 92% said no. Yeah, I don't either. I just don't think it would end well for me. All right. Freebird says people need more fun in their life. I don't know. I play speed chess. That's fun. All right. So RA wants to know, I'm going to buy a car in the next couple of years. Is it better to buy cash from savings and avoid a loan and interest, or finance rates up in retirement, have cash currently not taking from retirement? I don't necessarily follow the second part of your question. I just generally think it's best to pay cash for a car. Now, we weren't always able to do that, but once we were, that's what we've done. And we've paid cash. We've not had a car loan since 2002, 2003, something like that. Thrones Man says, isn't that, which I'm not sure what that was referencing, just what app the robo-advisors like M1 do with their smart transfers? I'm not sure. If you could provide a little more context. You probably, when you made that comment, whatever I was talking about, it probably made complete sense. But that was a while ago, and so now I've forgotten. All right. All right. Do. DB Douglas, I just removed him from chat. All right. Fidelity retirement score tool. Yes, I will do that. Let me pull it up. Yeah, I will look at that. Greg, this is a great question. So Greg wants to know thoughts on holding FM, FEMKX, and FDIVX as 3 funds to have for the international exposure of a portfolio. I know not your preferred, but would you be mad at me for holding these? That's the funniest question ever. It's not my money. I'm just kidding. That's true. Okay, I don't even know what these are. FM is iShares Frontier and Select. It's expensive, 79 basis points. You can see that here. And if we go to the portfolio, what I'm interested in, it's a mid-cap value, but it's a frontier fund. So if we go to countries, yeah. So by the way, I have no qualms with a frontier kind of approach. If you had a total international fund, it would include not at these levels though, but it would include, emerging markets, frontier markets. But that's just part of your holding, right? So let's see what else we've got. So that's expensive though, so it's not a fund I would own. Okay, so this is the emerging markets, and it's 88 basis points, so expensive. Wouldn't own that fund either. You're 0 for 2, man. 0 for 2. Let's see if it's a strikeout. Now this fund is expensive, as I recall. Yeah, but it's actually had some decent returns, if I recall correctly. But yeah, to me, you'd just be better. For me, I just would do a total international fund. I wouldn't add the complexity. I wouldn't add the fees. So, mad? No, I'm not mad, Greg, but I'm concerned. I'm not going to lie. All right. I got to go to Portfolio Visualizer on this one. I don't know how much data we have on these funds. And you didn't tell me what percentages you have, but I'll just put a third into each for now. See if we can get much data on these. Watch, they'll clobber a total international fund. And then we'll compare that to, there's not going to be much data. Oh, I've got to put 34 for one of them. I'll show you this in a second. Well, look at now you may not have these percentages, but This goes back to 2013. That's not too bad. That's 10 years, we'll call it. And Portfolio 1, these three have outperformed with lower standard deviation. Now, I don't know if your allocation is a third of each, but I would be real concerned that it can keep up with that over the long term with those fees. I would think that it's unlikely. That's what I would think. And I was just looking at the individual years. And also, I'd have to drill down into these funds in more detail. But, a third each, you've done okay the last decade. Can't argue with that. Sophia wants to know, they did a reverse rollover from an IRA with Fidelity. And they charged me $125. We do have a wealth manager from Facet, a flat fee company. How do I get my money back? I have no idea. Are you talking about the fee you want back? And you say reverse rollover. I mean, did you transfer it from Fidelity to Facet? And I have heard of Facet. Let me just look them up. Yeah, I don't know a thing about them, but here's their website. So I guess I need a little more information. Because what I don't understand is what Facet has to do with it. Because I don't think they're a 401k administrator. Well, maybe they are. But you say a reverse rollover. You went from an IRA to a workplace retirement account, like a 401k. And so I'm not sure what Facet has to do with that. So maybe a little more context if you can. Well, so iPad deck mount wants to know, what do you think of self-picked single munis, municipal bond funds, or municipal bond, as opposed to just using a muni fund for an after-tax account? Well, like picking individual bonds or stocks, it's a lot of work. In your case, I'm guessing you picked one from your state to avoid state income tax as well. I think that would be the advantage. If there's some funds, like if you live in New York or California, some of the larger states, you can find funds focused on that state. But a lot of states, you just don't have that. There may not be enough, a market for it. But so one advantage would be that you could pick funds from your state, assuming you don't live in the kind of states where you could just have a fund do that. But it does expose you to the risk of individual municipal bond funds. So that's what you have to think about. And there are risks to the municipal bond market. I'm no municipal bond fund expert, that's for sure. And it also, I think, would depend on how much money we're talking about relative to your portfolio overall. If it's a relatively small amount of money, that's fine. But if you're going to put, if you've got 30 or 40% in bonds and you want to put them all in individually selected munis, then I'm sure that's not the case. But if that were the case, that would give me great concern. So Mike says, Dr. Pfau has done great research on equity and annuities versus equity and bond portfolios and found the former supports a higher spend rate in retirement. Yeah, and I've read some of his research. I am going to reach out to him and have him on the show to discuss that very issue, and looking forward to it. But there's still downsides, right? Because of legacy. If you want to leave money to charities or your children, not that you have to annuitize your whole portfolio. I understand he's just talking about the bond portion. But I have other concerns that I want to ask him about. I mean, annuities are not indexed to inflation. And so I'd like to get his take on that and how you go about, thinking through how much you annuitize. So I will reach out to him. And here's JPZ. JPZ used the Fidelity planning tool to run models with and without an annuity, and they determined that they were better with some portion of their nest egg in an annuity. And I will tell you, my instinct tells me I'll never buy an annuity, but I am starting the process of researching that in a little more depth for us. I still would be surprised if I ever bought one. But part of me thinks about it for my wife. Should I get hit by a truck? Should I kind of think about that now and give her some guidance now? I don't know. After a while, though, you kind of get tired of thinking about what happens when you get hit by a truck. Okay. Yeah, so this was the question that we looked at before, and I started to think about it. I still need some more details. So like if the issue is if you rolled it over into a 401k and you want to get it back into an IRA, that can be difficult while you still work at the company unless they have in-service rollovers, and most don't. But again, I'm not sure I understand. I think I need more detail on the question. Kathy wants to know my thoughts on Michael Burry's prediction on the market bubble burst due to us all over investing in index funds. So he was the guy that, shorted the mortgage market and made a fortune. Smart guy. I follow him on Twitter. I don't know if that's all that relevant to the conversation. I don't understand his reasoning behind it. I just don't see index funds as what's causing the overvaluation. I think it was easy money, not just low interest rates, but government flooding people with money. And it wasn't just direct stimulus checks. We flooded the state and local market with governments with money they didn't need. And of course, what do they do with it? They don't give it back. They spend it. I've talked to folks in the budget departments of cities in Virginia, New York, Connecticut. They all say the same thing. We had so much money we didn't know what to do with it. They were building schools they didn't need. They were hiring, New York City for the Parks and Rec department. They just hired people. We got this money. This is hire. It was temporary, but that seems to me to be a better explanation of the markets than index funds. But he's a smart guy, so I don't know. I don't know if I've ever seen where he's really gone into detail explaining his reasoning or thoughts on that. If anyone knows of that, leave a link. I'd like to read it. But all right. So I guess it's Thamo. I purchased a variable annuity in 2018. It is now below water. So let me first flaunt my ignorance. I don't know what that means. Its value has gone below what you invested in it, I guess. I don't know. I've never owned a variable annuity. Should I surrender it and put it in an index fund? Well, I can't answer that question in abstract. I don't know what the charges are to surrender it. I'm sure you're going to have to pay a fee, right? If you bought it in 2018, I would think you'd still have to pay a fee. Probably the first 10 years, right? Would be my guess. But so that would be a question. I'm not a huge fan of variable annuities. So for me personally, if I woke up one day and I found myself in a variable annuity, I'd probably do what I could to get in an index fund, but I'd have to look at the tax consequences, the fees. So yeah. And I don't know, of course, I don't know what those would be for you, but those would be some of the questions I'd be asking as part of that decision. You also have to think about your ability to withstand the rises and falls of the market, which we're obviously seeing now. But of course, you're going to feel some of that in a variable annuity. So Jay says, so they switched to Fidelity. As a new client, they provide you with an assigned account manager, but I don't know why. I don't know why. I mean, I got one too. I don't know, but it's nice to have. I give them a call every now and again when I have a question. Oftentimes, though, I just call Fidelity. I had an RMD question today. They were great. Thrones Man wants to know, can anyone sign up for an HSA if they have the appropriate health insurance, high deductible plan? My employer provides health insurance, which is not HSA eligible. No other options, but I'd like to start. Well, I don't know how you do that. If your employer doesn't offer an HSA eligible plan, I'm not sure how you would do that. I mean, unless you're saying you're going to go get your own health insurance, but I don't, that may not make sense if your employer's providing one, assuming they're paying for a portion of it, if not all of it, or they're probably not paying for all of it, but a portion of it. I would think you'd want to stick with that, I think. And then there could be some restrictions on not accepting their health insurance, right? And I don't know if this is the norm, but unless you're getting health insurance through, say, your significant other, you might be forced to take their health insurance. So you might want to check that out. HSAs are great, but you still, if you're paying more for insurance than you have to, just to get an HSA, I'm not sure that necessarily makes sense. So Jeffrey wants to know do I understand you correctly? No REITs in a taxable account. Yeah, I keep REITs out of a taxable account because of taxes. So Conscience wants to know, and by the way, welcome. I don't think I've seen a question from you in a while, if I'm remembering correctly. What would be your favorite LCV ETF mutual fund for Fidelity? So large cap value ETF. Well, why does it have to be a Fidelity fund? Even if you have a Fidelity account, you could, I have the Schwab fund at Fidelity, but I don't have one off the top of my head, a Fidelity fund. Fidelity fund, large cap value. I'm going to see if they have an index fund because that's what I would go with. Yes, they do. Fidelity Large Cap Value Index Fund. FLCO, is that right? FLCOX. Take a look-see. Here it is. Just 3.5 bips. I mean, when I see something like this, I don't even really have to do much analysis. This would probably fit the bill for me. Look at that. Berkshire is the number one holding. Can't go wrong there. See, these are typical value stocks, right? J&J, Exxon, JP Morgan, Chevron, Pfizer, some crazy company called Meta. It's kind of funny now that it's value. Anyway, Bank of America. Hey, did you see my Bank of America stock was up big time? Let's see what if we go here. Look at this. It was up 6% today. Woohoo! They had a good quarter. It'll come back down. So that one seems reasonable to me from just a quick 30-second evaluation. Would it still be wise, NE wants to know, to invest in VDE? I have no idea. I don't even know if it was ever wise to invest in VDE. Let's find out. Vanguard Energy ETF. So another sector ETF. I just never invested in sector ETFs. I'm curious. I imagine this is a very risky, very volatile, I would think. Yeah, look at the standard deviation, 44. Hello. So all I can say is buckle up. Although that doesn't look too crazy. Although it does look flat. Yeah, it's pretty bad. 25, down 10, down 23, up 29, down 2, down 19, up 9, down 33, up 56. I think my question would be why? What is this fund? What problem? What are you missing in your portfolio that you think this fund will provide? To me, it seems like all the volatility with none of the returns. Although year to date, it's been great. I mean, it's up 50% this year, but this year ain't normal. It's 15-year total return, 2.72%. Now, That doesn't mean its next 15 will be that bad. And we did go through the financial crisis and recession, and that certainly influenced it. Of course, 15 years. Yeah. Well, yeah, that put us back to 2007. All right. Crown wants to know, what do you think about 100% VT in a Roth IRA? I think that's fine. VT is Vanguard's total stock fund, total meaning domestic and international. You know, I mean, there's always the question of your overall asset allocation plan and all these sorts of questions. But, you know, you've got a fair amount of international exposure. So for that reason, it wouldn't be my choice. It's 40% international. But one, that doesn't mean it's not a reasonable choice. And two, that, you know, this is just in your Roth. So depending on what else you have allocated in other accounts, this may not reflect, you know, your overall stock allocation anyway. A lot of fund questions tonight. Can you compare VFIAX with SCHD? I really don't even need to look them up, but we will. So VFIAX is just an S&P 500. It's VOO, VOO. This is just a mutual fund version of it. And the way to think about this fund, it just basically covers the large cap space in the US. And if we go to weights, you can see it's predominantly large cap. It's tilted a bit towards growth because of those pesky tech companies still. But it sort of covers the gambit, right? What SCHD is going to do is tilt towards value. And we can see that. Let me go open up a different window and we'll look at this together here. Now, one thing I'll say, I don't remember, I'll pull your comment off the screen. You know, if this is in a taxable account, SCHD throws off a lot more taxable income. Let's go back to the quote page for a second. You can see it's got a yield of 3.8 almost. The S&P is what? 1.7? 1.76? So you're going to pay more in taxes if it's in a taxable account. But looking back at the portfolio, you can see SCHD is tilted towards value. So if we look at companies, we looked at this or something similar. But these are old school, you know, IBM, Home Depot, Pepsi, Coke, Cisco, Verizon, you know, sort of old school companies. If for sort of a long, if you said, okay, we're going to pick a fund and we're going to stick with it for 30 years, I would pick the S&P 500. I have shares of this fund. It's a limited amount to tilt my portfolio a little bit towards value. And given the higher valuations that we've seen recently, they've obviously come down a lot this year, I was more comfortable with this fund in the short term. Long term, I think this will still be a really good fund. It's just that the core of my portfolio, I would want to be more diversified. If you want to tilt a little towards value, I think this fund is a good option. And it's probably, I'm sure it's not done as poorly this year as the S&P, but it's still down. It's down 13%. S&P is down more than that. But again, I wouldn't read much into that. But it's still fun to look at. Yeah, it's down 23. So I think they're both good funds. They just serve slightly different purposes. And I own them both. So that's an option. Well, actually, I own a total U.S. stock market and SCHD. Bob wants to know if DGRO would be okay for a taxable account. I don't know what that is. For some reason, though, I'm going to say no. Let's look it up. Oh, core dividend growth. Its yield's not too bad, 230. That probably wouldn't scare me away from a taxable account. But let's look at distributions. So no capital gains distributed. What's an ETF? So that makes sense. Yeah, I wouldn't necessarily avoid this in my taxable account. No. Do we have any polls going, or have I already stopped them all? I did. I need to come up with another question to ask you guys. Aaron, it would be lovely to meet you. Chicago, well, so we were in a suburb, so we weren't in Chicago downtown, which is kind of a bummer. But I mean, yeah. So I really didn't go to Chicago. I went to Oak Brook. I think that's where it was. All right. So Shredder says, I heard the U.S. is maxed on credit default swaps. Do you have thoughts on that? I don't know what that means. I mean, I understand generally what a credit default swap is, but I don't know what you mean by the U.S. is maxed on. I mean, they're basically insurance contracts, effectively, right? But I'm not sure what that means. Was there some news article? U.S. maxed on credit default swaps. Go to news, maybe. I'm not seeing anything. I don't know. I guess I don't have a thought on that, I'm afraid. Well, this is interesting. So I've not heard this before. Bill said he tried to buy a gift bond after buying his personal bond, and it said that my account may be suspended if I purchase more than 10,000. I've never heard of that before. I have heard people get messages that say the money will get returned to them if they buy too much, but I've never heard of this. So yeah, I'd be concerned. I guess I'd call them, figure out what's going on. I've never heard that before. That's the first I've heard of that kind of thing being reported. All right. Man, is it almost 8:30? How about some non-financial questions? Those are my favorite. I kind of feel like my job each Monday night is basically to stress the importance of simple, low-cost investing and kind of block all of the, what about this fancy way to invest? No, don't do that. What about this expensive way? No, don't do that. I don't know how well I'm doing. Man, it's amazing how many comments I don't get to. I've scrolled all the way to the bottom. Ugh. Bill, you're killing me here. Inspired by you, I've fired my advisor and currently out of the market. Would you recommend dollar cost averaging in or jump back into a 3-fund or ultimate buy and hold portfolio? Well, Bill, all I can tell you is what I do, and that is I put my money to work. I don't dollar cost average in, assuming I have the cash. You know, which one will work out better depends on how the market does over the time period that you're looking to dollar cost average in, and I have no idea what the answer will be. So that's my approach. Yeah. Just seeing what else we got here. Josh got the same warning on trying to buy IBond as a gift. So there's 2 people. So I don't know. I don't know if it's the website. I mean, first you couldn't do it. Then people did it without any issues. Now, 2 of you have now said you got a warning. I don't know what the answer is. I don't know. You could get on hold and try to call them. I say on hold because it's usually hour-long wait, which is unfortunate. All right. So I appreciate all the great questions. I'm sorry, as always, I can't get to every question. I wish I could, but I can't. I am going to have the first sort of tool analysis up on Wednesday for Personal Capital Retirement Planner. I think Projection Lab will be next. I'll try to get that. I'm going to try to do one a week. So if you have more thoughts on tools you'd like me to evaluate, you can just shoot me an email. And yeah, I'll get to them as quickly as I can. It's been a lot of fun just trying to see how the different tools work and the different assumptions that they make. And I'm looking forward to Projection Lab. It looks like a cool tool. So I'll have that, like I said, next week. And there you go. So thanks for joining the show. I hope you guys have a great week. Yeah. And until next time, remember, the best thing money can buy is financial freedom.